You know, there's a force out there, an invisible hand, that might just be the single most powerful lever in the entire global economy. It can send markets soaring to record highs, or, just as easily, bring them crashing down. And honestly, it's not even an exaggeration to say that when it comes to the world of finance, this one thing, it pretty much controls everything. So let's dive right in. In this explainer, we're going to pull back the curtain and see exactly how this one powerful lever manages to move, well, everything. From the stock market and crypto, all the way down to the price of your own home. All right, but before we get into the effects, we got to understand the cause. And it all boils down to a really simple concept: the cost of money.
So what are interest rates, really? Think of it like this. An interest rate is just the price of money. Simple as that. It's what you pay to borrow it, and it's the reward you get for saving it. And crucially, the folks who get to set that price, that's the central banks.
And this is how it all trickles down. It's a chain reaction, really. It kicks off with one big decision from a central bank. Then, all the commercial banks, the ones we use every day, they have to adjust their own rates. And boom, that change lands right in our laps, affecting everything from our car loans and mortgages to how businesses decide to expand.
Okay, so let's look at our first big example, stocks. Now, if there's one market that gets jumpy about interest rates, it's the stock market. It's incredibly sensitive to even the tiniest hint that rates might change. So that begs the big question, right? For anyone who invests, why is it that higher interest rates almost always seem to spell trouble for stock prices?
Well, you can really think of it as two totally different universes for stocks. On one hand, you've got a low-rate world. Money is cheap, companies can borrow and grow like crazy. But then you flip the switch. In a higher-rate world, borrowing suddenly gets expensive, and that puts the brakes on growth. But here's the real kicker. Higher rates make a company's future profits worth less right now. See, investors use what's called a discount rate to value those future earnings, and that rate is tied to interest rates. So higher rates, boom, lower stock valuation. It's almost like a law of physics for finance. All right, let's switch gears to the Wild West of finance, crypto. Now, if stocks are sensitive, crypto's on a whole other level. It's what we call a high-risk asset, and its lifeblood is the amount of extra cash or liquidity that's just sloshing around the system. It seems kind of weird, right? How can a decision made by a bunch of people in suits in a boardroom possibly affect the price of something totally digital and out there like Bitcoin or Ethereum?
Well, it all comes down to one thing: risk appetite. When interest rates are super low, money is cheap, and savers aren't making much. So investors get bold. They start hunting for bigger returns, and that means pouring money into riskier things, like crypto. But the second rates go up, that free-flowing cash dries up. It runs for the hills, back to the safety of things like government bonds. And that basically drains the fuel from the crypto engine.
Okay, let's bring this all home. Literally. The housing market is maybe the best, clearest example of how a decision made by a central bank can reach right into your wallet.
So what's the direct connection between that big policy meeting and the price of a home? It's one word: mortgages.
And here's how that plays out. When rates are low, getting a mortgage is cheaper. That means more people can afford to buy, which cranks up demand and, you guessed it, pushes prices higher. But when rates climb, so do those monthly mortgage payments. Suddenly, fewer people can afford to buy, demand cools right off, and the whole market hits the brakes. Okay, so let's zoom back out for a second and tie all of this together. We've looked at these markets one by one. But the real power, or maybe the real danger, is seeing how they're all linked. So we've got stocks, right? Higher rates squeeze their valuations because their future profits just aren't worth as much today. Then there's crypto, where higher rates basically suck all the speculative money right out of the room.
And finally, housing, which gets put on ice because mortgages become too expensive for many people.
And that brings us to the most important takeaway. When a central bank tweaks the cost of money, it's never just about one market. It's a massive ripple effect that spreads everywhere, as big money constantly moves around, flowing from one place to another, always looking for the best possible return. So that leaves us with the million-dollar question, doesn't it? In a world where every market is connected by this one single force, the cost of money, the only question that really matters is, where is all that capital going to flow next?